Hey guys, what's going on? Welcome back. So in this video, I'm going to be going over Starbucks, and I'm going to be talking about the massive pullback that Starbucks has been experiencing. You can see right now it at one point was down over 16% from its all-time high, and a lot of people are looking at Starbucks right now that didn't get in back here. Like I said, when I first started covering it on the channel, a lot of people are wondering, hey, is right now a good time to buy it on the dip? And so there's a lot of things that are going on with Starbucks right now that are making the company have this sell-off. If you look at it over the past year, it has been, an amazing outperformer compared to the overall market. But a lot of people are thinking back and realizing, like, hey, is right now a trap? Is the valuation a little too stretched and it's just finally coming back down to earth? Or is right now a great buying opportunity and then it's going to rally another 40% from here? So I'm going to try to dissect that. I'm going to go over, what are the different viewpoints I'm looking at the company from. I'm going to be going into, as a long-term shareholder, do I think right now is a good buying opportunity? Or, would I still rather hold off? Or, the things that are going on with Starbucks right now so bad that I might actually be selling my position. I'm going to be going into all that and then a little bit more. And then I'm also going to be going into the numbers and breaking down exactly where are these estimates coming from these analysts, whether they're upgrading or downgrading Starbucks stock. Really, what are the growth rates baked into those numbers that you at home can kind of think about for yourself and like assess really where do you think Starbucks, how fast do you think Starbucks is going to grow? And then what share price are you willing to pay for the company, assuming your own individual growth rate? So I'm going to be going into all of that. And hopefully you guys get some use out of this. I will be referencing my model. So if you guys are following Starbucks, you'll be able to look at the numbers that I plug into the model and kind of see, based off of the numbers I show, do you agree with those numbers? Do you disagree with them? And then you can kind of use that as a gauge for, okay, do I think Starbucks is fairly valued, undervalued, or overvalued? And so I'll be getting more into that in just a bit. But so without further ado, let's go into the overall scheme of things and let's look at the macro first and see what the heck is going on with Starbucks stock. All right, so there's been a lot of things going on with Starbucks, but let's just start at one of the more recent developments, and that is that Starbucks is getting kind of dragged into the Hong Kong protests. So I'm no expert in what is exactly going on in Hong Kong, but from the research I have done with it, it seems that there is a lot of civil protests that are going on in Hong Kong between the fact that Hong Kong is essentially separated from like Beijing and the rest of China, and the citizens of Hong Kong aren't too thrilled about that, and especially the fact that Beijing still seems to be able to govern Hong Kong and enforce their own rule in their own jurisdiction, and without the citizens of Hong Kong really being able to do anything about it. And so there's been a lot of like fighting between the two parties, and that kind of has spilled over into all the shops that are in Hong Kong. So there's been a lot of graffiti going on at Starbucks locations. A lot of people have just been not going to any establishments that aren't, like say mom and pop shops that are in the Hong Kong area, just so kind of they can kind of push out the economic driving forces in Hong Kong, because Hong Kong, in the grand scheme of things, is one of the most luxury places to be right now. They make a lot of money, but there's all these political issues going on right now because obviously it's really only helping out the top 1% of the citizens in Hong Kong, and everybody else feels like they're getting shafted and unjustly treated. So I'm not going to definitely say that I know too much of what's going on here, but the grand scheme of things that people are kind of worried about Starbucks' locations, since they've been expanding in China for so rapidly over the past couple of years. People are worrying that that's going to be a negative catalyst on Starbucks' growth in China. So I'm not too worried about that from a shareholder, and I personally think that this was just kind of noise that was kind of thrown into the stock market once Starbucks already started to get kind of weak knees and was already seeing some of its pullback. Another thing that's going on in the news right now is that Starbucks is going to... And then something I want to keep in mind is that if you look back after what they just released with their Q3 earnings report, Starbucks is... their debt is piling up still. So right now, in long-term debt, they have just under $12 billion, and they just added in another $2 billion this past quarter, and their interest rate is starting to hike up for what they're getting their debt for. So you can see right here the notes that are due this year, or that were due last year, and then the notes that are due over the next couple of years. Very low interest rates, under like 2.5%, maybe just under 3%. But recently, some of the more hefty loans are getting above a 4% interest rate. And that's starting to add up. Like debt, when Starbucks was like really packing on the debt was really cheap. And Starbucks was able to take that debt and explode the amount of money that they were generating. They had a massive surge in free cash flow. They had a massive surge in revenue. And they were also able to use that debt to buy back a lot of stock at a very cheap price. And then that was able to push their stock price up even further. And it was able to make shareholders very happy. So a lot of people for a while now have been pretty happy with the amount of debt that Starbucks has been packing on right now. Because, yeah, it's been risky. But when you look at the interest rate that they have to pay on it, up until very recently, it was kind of a joke. And that if the company could just continue to execute the way that they had been in the past, they'll be able to expand very quickly with essentially for free money because of how low the interest rate was. But now that's no longer the case. And this is starting to creep up. However, and I'll get into it in a little bit when I get into the numbers, the interest rate is starting to go down. The federal funds rate is starting to go down. So assuming Starbucks is able to turn any of these into variable rate loans or refinance them, they might be able to get a cheaper interest rate and maybe even get it back down to like around here in the below the 3% rates. In that case, Starbucks would be able to grow at a much faster rate than they have been over the past couple of years. So it'll be pretty interesting to see how that goes, but that's kind of the biggest thing that I would keep in mind of in terms of the balance sheet and in terms of the real fundamental things that are going on with Starbucks. Because Starbucks, it's a coffee shop. There's not a lot of new things that are going on in the space. Like, yes, some competitors come, but Starbucks has a vast majority of the market share. And so the main thing, in my opinion, that an investor needs to focus on is that they want to make sure that Starbucks sticks around for the next 10 years. And Starbucks has been playing the kind of risky game. Let's load up on debt so we can expand really quickly. But if they ever stop expanding or if they ever have a major contraction in sales, having a lot of debt will make them implode. So that's something you really need to keep in mind with, and that's something you need to put into your risk profile. Because as of right now, if Starbucks continues to take out more and more debt every quarter, their risk profile is going to go very high up. And even though that they're a low beta stock, even though it's a consumer cyclical, but it's, one of the less cyclical ones in nature, and it's not like a tech company. There's not a massive amount of disruption. Their financing may be their downfall if they don't really keep it in line. So that's something you really need to keep in mind. If, say, Starbucks, they try to do another major expansion into a different country and they add like $4 to $5 billion of debt in just a year, that might be it for me, and I might have to break up with the company off of that. I really hope that doesn't happen, but right now Starbucks is kind of like skating on a fine line whether or not they're being responsible or irresponsible with debt just because it's at a cheap rate. So that's something I would definitely keep in mind from their last earnings report, and I think that was the biggest thing to look at. Now, from a valuation standpoint, Starbucks is definitely not cheap anymore. So you can see, like right here in 2018, in Morningstar, it records it for the year. It was just under 20. I will say that when I bought it, when it was under $50 a share, it was, I believe the PE ratio was skating around a 16. I believe it was a 16 and a half. And compared to the company that is normally traded between 25 and 33 over the last 10 years. You can see here the 5 years at a 28, and compared to the overall index that's at a 20. Starbucks hasn't been growing as fast as it had been in the past to justify a 30 PE, in my opinion. So when I was buying in when it was below 20, I thought it was a steal because I still thought there was some growth left in the company, but I definitely don't think China is going to grow as quickly as it did in the US. But, that's all kind of betting on how well they expand in China, because China could essentially double the company, even just by a revenue standpoint, but also probably by a market cap standpoint, in a very short amount of time if they're able to execute well. But that's a big risk that you have to factor in with it. But right now, on a multiples level, Starbucks just kind of seems fairly valued to the way it's been, maybe slightly overvalued to what it has been over the past 10 years. So it's definitely not a screaming buy by a multiple standpoint, but at the same point in time, like, what do you want? You have someone that's buying back shares, that's pushing up the share price. You have people that are increasing the dividends, so it's making it more attractive to income investors, while at the same time, their revenues are going up and up. So, it's kind of like Starbucks is executing really well, but it's just getting priced as if it's going to continue to execute really well, and that's going to make your returns as an investor really diminished, at least, especially when you look at it from a risk-reward standpoint. As you can take a look over here, and you can see the growth. Morningstar actually already rated them. They downgraded them to about a 3-star, which means that it's a good company but poses a lot of risks. So that's something you definitely want to keep in mind. The revenue growth rate has been slowing. So if you look at like the 10-year average, it has been like dwindling down in recent years. But it'll be interesting to see, kind of what direction it goes in that. But then you can take a look at all the financial earring that's going on with the company, and their EPS is ballooning to all hell. It's a complete ramp up, and a lot of that EPS growth is financially engineered because Starbucks is able to borrow debt, which makes their cost of capital go down, and they're able to buy back share with it, which also makes their cost of capital go down. So their ROE just starts to balloon, and so their earnings per share starts to balloon in proportion. So that's something you need to keep in mind. But now to wrap up this video, because it's getting kind of long, let's take a look at the free cash flow model. So this free cash flow model, again, I will eventually provide this for everybody that you can download it and you can play with the numbers yourself. But the data source that I'm getting it from, being Morningstar, they just changed their data layout, so this stopped being super friendly when you needed to go and update it. So I need to revise it, and I need to redo all of these companies. So that's going to be a fun 20, 40 hours worth of work. But taking a look at it, you can kind of see, like right now, what's going on with the company. Based off of what was their new guidance that came out after their last earnings report, they said that they are now going to be pulling back the revenue estimates from 11% to about 7 to 9%. And so I'm going to be taking, so this is the WACC when it's actually calculated. I'm going to be giving them a 5 because I don't really like WACC in general, but it's just the way most models work, because WACC has to incorporate the beta, and the beta has to assume that just judging how volatile the stock is changes the risk to the stock, and I think that that's just kind of ludicrous. But, that's just the numbers we have to work with. So what I want to be going with is, okay, so I want to assume it's about 5%. Starbucks also has a massive amount of debt, as we saw earlier. And as interest rates continue to go down, this number will continue to go down, which will make Starbucks more and more valuable. So the way you can think about it is that if interest rates start to drop, then companies that have a lot amount of debt will become, more profitable essentially, because now they're able to refinance their debt at a lower rate. Their cost of interest will go down, so their net profit will go up. So if you have a company that has a lot of debt and interest rates go down, those companies will generally outperform. On the flip side, if you have a company that has no debt and interest rates start to go up, that company will generally outperform its peer group because it doesn't have that interest expense. So that's just something you can keep in mind with. Short-term growth rate, assuming we're on the lower end of the spectrum and say we hit that 7% out of that 9%, going all the way down to a 3% for the next 4 years if things aren't going too great. These are the different share price premiums that I'm willing to pay. And right now the stock price is at about an 85. So with these assumptions, and these are pretty conservative assumptions, but being where we are in the overall economy, I would rather be conservative right now than I'd be aggressive. On the flip side, if we start to, if things start to look better and everybody thinks that we're going to have many more years of economic growth, and we change the long-term growth rate with Starbucks to about a 3%, which is still doable. It's still very doable, but it's not conservative. It would be Starbucks has to continue to execute well for the next 10, 20 years. And that's one of the reasons why I don't really want to use it. But if you think Starbucks is going to be able to grow its top line at 3% forever, the shares are very underpriced right now. You have about from growing 7% for the next few years to a 3% forever. You have about a 40% discount on it. And so you have a 40%, say, margin of safety. But if you just quickly take that away, you essentially get rid of your margin of safety and you're paying fair value for the company. So what would I do? I'm personally waiting for Starbucks to trade below $70 a share before I add any more. I bought into Starbucks when I was first buying into them. Again, I was buying between $45 and $50 a share. So, the share price has to retreat a lot for me to justify averaging up into it, essentially. And Starbucks is also one of the companies that if we really do hit a hard economic time, I think is going to drop to the floor. And that's when I really plan on buying it. I do think Starbucks is going to be an amazing company to own for the rest of my lifetime, at least. But I know that due to the nature of the business, it'll be an amazing stock to buy when things are going wrong and when, you know, everybody's running for the hills. So I'm more or less keeping my hands off for it, keeping up to date with the company, seeing what's going on. But right now, Starbucks isn't trading at a valuation that I am too thrilled to be, you know, loading up the truck on. So that's just kind of my stand on it. Let me know what you guys think in the comment section down below. I would love to hear what you guys think, what your valuation on Starbucks is. And that's about it for this video. Hope you guys got some use out of this. Let me know what other companies you guys would like an update on. And let me know if you actually like this type of video layout with me just kind of talking about and catching you up to date with individual investments and then kind of where I see them going. Really mean a lot. I think that this is more valuable than some of the content I've been putting out, but you know, that's your guys' decision. So let me know in the comment section down below. All right. Thank you guys again for watching, and I will catch you guys in the next video. Peace.